Joey, mate, I am super excited today. I've got one of my really good friends on the podcast, one a big expert in the area and especially in his specific area. And I think it's pretty timely that we're having this type of conversation. It's Mike Mortlock from MCG Quantity Surveyors. And, you know, I've been on Mike's podcast. He's got a podcast called Geared for Growth. It's a phenomenal podcast. It's got some cracker guests and some cracker insights on it. Joey, I know you're an avid listener too, but Mike, welcome to the podcast.
Thanks for having me. It's nice to chat to you again, Jordan, and to be on the line with Joey for the first time.
Yeah, really looking forward to this. We just had a quick chat off air, and I was kind of saying it was really timely because, I mean, my brother's kind of going through his first investment as we speak now, and he's been asking me lots of the questions that we're going to be putting to Mike today. So really excited to jump into this one. Yeah,
awesome. You can just forward it through. And it's tax time too. So
Yeah, you must live for this time of year, right?
The planets of a lot. Yeah, this is like the Super Bowl, the Tour de France, what other sporting things can I throw in there, all rolled into one.
Is it though, or is it the opposite? Is it kind of like a big rush? Everyone wants their tax deductions in order before tax time. Like, is it pretty crazy this time of year?
It's where I collect about 90% of the year's grey hairs. But, we know it comes every year. There's no holidays in June for the MCG team. We're ready to go, and we're passionate about the results we get for our clients, so that helps us get through the stress of the work volumes that come in this month.
Yeah, at least you know what you're up for and what to expect in this month, and you can ramp up. But for the people that don't necessarily know what a depreciation schedule is, or what are the sort of things a quantity surveyor can provide and the insights, can you give us a bit of an overview of what a depreciation schedule is?
Yeah, well, it's simple as a report that shows you the tax deductions that you can claim each financial year based on owning an investment property. So it works for commercial and industrial property as well. But in essence, as a property investor, you're providing a service to a tenant, right? You're providing housing. So you can claim deductions based on the wear and tear that's incurred by running that property. So you think of it like a business. The business is to rent it out. A cost involved in renting is to maintain the property, and it does wear out with use. So that's kind of the allowance. So it's really simply just a report that says, okay, well, your taxable income might be $100,000, but there's $11,000 worth of deductions. So then in the eyes of the tax office, you're only earning 89. And the difference between, say, those two amounts is about $4,000 of tax savings with an $11,000 deduction on that sort of income. So yeah, it's an important thing to help property investors with their cash flow.
And I assume we'd be here for about a year if we went through absolutely everything that is that can go on that depreciation schedule. But do you mind running through some of those like higher level things, and maybe more importantly, or more commonly not spoken about, what would be left off those depreciation reports?
Joe, if you want a year, strap yourself in. I can make this happen. I've got a bottle of water. I've got some hand sanitizer. I'm ready to go. Well, high level, it's the way that I like to describe it is there's kind of like two buckets of tax depreciation. There's the building structure, which is, as you might think, it's the timber frame, it's the concrete slab, it's the roof, whatever you decide to make that out of. And then there's the plant and equipment items, which are more sort of like the loose fittings, so carpets and blinds and kitchen appliances, hot water systems, and those sorts of things. So those are the two different categories of depreciation, and there's different sort of qualification as to whether you can get those deductions based on the age of the property. But those are the sort of the two main key components of a depreciation schedule.
And it seems like it's like ramped and changed up fairly recently in the last couple of years. And there's always sort of some changes in legislations that come through. Do the types of things that you can depreciate change regularly, or is it pretty stock standard and like different numbers and all that sort of stuff?
It changes every year. It changed for residential 2 years ago, and that was the first change since about 2005. So it is pretty constant. So 2 years ago, they added a couple of items and they changed some effective life. So carpet went from 10 years to 8 years, and then they added a couple of things. And my actual favorite residential asset, which it's weird to think that you've got a favorite, but they added digital peepholes, and I just think that's fantastic because it sounds so creepy.
What's a digital peephole?
Well, it's kind of just like a little intercom thing, right? So it's rather than the little hole that they put in the door, it's a video camera with a projection on the other side. But it's just
Digital
that someone at the tax office has decided, well, what are we going to call that? Is it like an intercom? No, people won't know what they're talking about. Well, it's a digital peephole, and there's probably someone at the back going, oh, I don't know about that.
Why wouldn't
How
you
that
just
got the
say
green
like
light?
video intercom or something? What is digital peephole? That is
Digital
bloody creepy.
peepholes.
And
Yeah.
and in
I
that
haven't put one in the
scenario,
report yet.
when things do change, do you have to get a new depreciation schedule, or can you just tack on the changes in your old one?
Well, the changes aren't retrospective, so they're only sort of from people that are exchanging from that sort of legislation onwards. So it normally happens in the first week of July. They come out with a new tax ruling, and it'll be called something like TR 2020/2 or whatever. So it changes a lot for commercial properties. They add lots of new industries. So a year or so ago, beekeeping got the nod, and there's all sorts of new beekeeping assets. But there's a lot more commercial in there than resi, and that's pretty constant.
Joey, I think we found your new career, mate.
If only I loved honey that much.
There's real buzz about Joey.
in terms of like we've all heard the kind of the common rhetoric around, oh, you can depreciate this for however long. Like, what's I know each particular item, as you mentioned, has their own kind of, I suppose, years or shelf life. But like, how long in general would that depreciation report, let's say we took it out now, how long would that quote unquote last you?
Yeah, well, 40 years is really the maximum for residential property. But even that, this is where we can talk for a year, because let's say you have a property that was built 40 years ago, right? So it will have, it's not going to qualify for those deductions because it's got to be built after 87. But if it did, it would run out. But then if it had a renovation, say 10 years ago, and it had an extension, well, that still has another 30 years to run from today. But 40 years is the standard length of a report, because that's normally the maximum effective life of any asset in the property. So it's 40 years for the structure. The plant and equipment's all different depending on what it is. So for example, there's a difference between a gas hot water system and a solar hot water system. They have different effective lives, but the building's 40 years, and most plant and equipment is kind of gone after 10 years.
I think that's a pretty good segue into sort of, and I know you were touching on it before, the difference between, maybe an existing older property, a brand new property, and then maybe a property you've done a renovation on. What are the types? Like, I know there's a specific date and time where these things roll over, and then you can do a renovation, start getting tax depreciation again. Do you want to just maybe walk us through that?
Yeah, so the simple things to remember are the 16th of September 1987. That is the key date where the property needs to have commenced construction after that date to be able to claim the original structure. So if you want to claim the concrete slab, the gyprock, the tiling, even the kitchen cabinets, it needs to have commenced construction after that date. If it hasn't, but it had been renovated after that date, then you'll still get those Division 43 or structural deductions based on when the renovation was done. The plant and equipment items, there was a change on the 9th of May 2017 that said, if you're buying a property after that date, to claim the plant and equipment items like the carpets and the blinds, you either need to buy a brand new property after that date or install a new asset yourself. So what that means is today, if you buy a place that's a year old, there'll be no claim on the plant and equipment items anymore.
Yeah, right. Interesting. Okay, I didn't even realize that was the case.
Oh,
and is there,
Joey, there's all the info you want and much less.
I'd assume that there would be quite a significant difference, but do you mind walking us through the difference between, say, a strata titled property and a freehold one?
Yeah, that's a really good question, because people don't realize that when you buy a strata titled property, you're buying a percentage of the common areas in essence as well. So if you have a strata titled townhouse, it might have a shared driveway, and let's say that there are 5 townhouses, then chances are you will own roughly 1/5 of that driveway as well. Now that gets a little bit more intense if you're looking into high-rise residential, especially if it's new and you can claim the plant and equipment items, because There might be, we see properties that have 6 lifts in them, and a lift can easily cost $1 million on its own. There are properties that have gyms and cinemas and car parks and that sort of stuff. And even things like gym equipment, there are different categories based on cardiovascular equipment like treadmills and exercise bikes, and then resistance equipment like the pulley based things. So when you buy a unit in a high rise, if there's 200 units, it doesn't always work this way, but it'll be somewhere around 1/200th of all that stuff is yours as well.
And that would be the same for, say, Jordan, the bricks and stuff of an apartment, if it was built beyond that cut-off date.
Yeah, the basement and all that sort of stuff. So what we do is we estimate the construction costs in isolation specifically of their unit, because they own all of that unit. And then, of course, there's the common areas. So there's the foyer, there's the levels, there's the basement. So when we do a unit, we've had people say before, I've got a unit and it's only 55 square meters, so it's a lot easier to do than a house, so can I have a discount? Well, the reality is, if there's 10 different levels and 6 levels of basement and a gym, we've physically got to go and look and inspect all of that stuff. So units can be far more complex than houses for that reason.
And that's a really good point too, because if you're listening to Mike now and thinking, how do you possibly factor in all these tiny little bits and pieces and understand what the distinction between certain gym equipment is and everything else that goes into it? I really want to understand how too, because I've had MTG out to a couple of my properties, and I was actually there with a guy at the time, and he literally took photos of every single thing you could possibly see in the house, and it felt like he was installing a digital peephole or something like that. I was a little bit creeped out. But how does it happen?
I've got to say, you get up to some weird stuff at your place, Jordan. I've been meaning to talk to you about it. We've had to turn the camera off.
No wonder you haven't talked to me for the last 6 months, Mike. Now, but how does it all happen in the back end? I mean, obviously you take the photos, and then what happens from there?
Yeah, so the idea is that we spend as little time as possible on site. Of course, the caveat there is we need to collect a fair amount of detail, so it can be quite a period of time on site. But a lot of the time we're inspecting a property that's got tenants in it, and they're not terribly interested in your tax return and your deductions. So we like to be respectful of that and say, look, we'll rip through here, but if you can just give us access to this common area, then you can buzz off and we'll just hang around here for a bit. That often gets us into trouble with the concierge, but we deal with that. So that information all comes back to the office. So the site information that we collect, the photos, for our team in the office to put all of that together. So with a strata title property, for example, we need to source the strata plans, because that'll have your entitlement. So if you've got one of the 200 units, your entitlement is never 1/200, because, say, the penthouse has a higher floor size, so it's going to have a higher entitlement and all that sort of stuff. So we have to calculate that. We're taking measurements of the area, so we're estimating the construction cost on an elemental basis for the unit, and then the common areas, and then all the individual plant equipment items as well. And in the unit there can easily be 100 odd across the whole thing, because we're talking a pretty long list of plant and equipment items in a unit complex.
Yeah, I think you're going to answer my question with you shouldn't, but I'm going to ask the question anyway. What do you say to those people who just try and have a crack at this themselves and have a swing, or even the accountant that goes, just leave it with me. If you've done a renovation, just let me know roughly what you've done and I'll be able to do this for you.
Yeah, isn't that something? There's something that I like to do with our new recruits. It's a bit like, hazing the apprentice. I sort of say, well, how about we do a depreciation schedule? I'll give you a calculator, a pen, and a piece of paper, and they sort of, a little bit of wee comes out normally, because it's one thing to understand it, but it's another thing to be able to crunch it sort of then and there. But the real, in getting serious, the really important thing, and why accountants shouldn't do it and people can't do it themselves, is that accountants and individuals aren't qualified in the eyes of the tax office to estimate construction costs. So if you have an investment property and you put, say, a split system in, your accountant is able to look up the effective life. They know the date that it goes in, so they can calculate how many days in that financial year, and your invoice will have the cost on it, right? So they can write that off for you. There's no estimating required. But even if you build a brand new property, let's say you spend 300K building a house, and people will say to me, well, why should I get you to estimate the construction cost when I know exactly what it is? That's a good question. We can't tell you that it costs more than what you paid. The ATO take a dim view on that. But what you don't necessarily know is the cost of the carpet that was installed, and the oven and the cooktop and the range hood and the air conditioning. Those are normally sort of hidden costs as part of the building contract. And even if they are provided, they might be sort of the cost that they purchased it for, rather than the total installed cost, because an architect has to design where your oven goes and an electrician has to install it. Those are all costs that need to be apportioned on top of the actual acquisition cost of that asset, if it makes sense.
Yeah, 100%. That's a really good point. I used to work for a builder, and we do the same thing. As as part of a sale, you'd include the aircon or free floorboards or whatever it might be. So it's not actually factored into the build cost that you're getting from the builder. So there's some really good highlight points. I guess this is kind of off the whim, but if someone was to get a depreciation schedule that hadn't had one before, I mean, obviously they all change and differ, but what would be sort of the average number in terms of return that they'd get, say, per annum or something like that?
Yeah, look, we actually collect live data on that. I don't have the window open. That would have been really helpful. But the last time we did a major analysis on it was $9,183 was the average deductions that we're getting across all residential property. Now that excludes just things like little extensions where they're saying the scope is to just do this. Like, I'm talking like full properties. Yeah, so that's the average deduction. And if you go back to my original point about, say, $11,000 worth of deductions being $4,000 back in your pocket if you're earning 100K, it's going to end up being a little bit less. So that sort of makes the value proposition very high for investors, because our fee is tax deductible, so you don't end up paying the full amount. So should you pay $600 or $700 to get $3,800 back in your pocket and in year one, and then subsequently more deductions later on? Well, the answer is normally yes. So I normally say to people, whether you use me or someone else, please use somebody, right? That sort of shocks people because they expect me to just hit them over the head to win the business. I care more about investors understanding about tax depreciation and getting those deductions, because there's a lot of deductions that are missed, that are floating out there in the ether, and it's my mission to get them for investors.
And so you've just kind of maybe touched on it there, but is that the rough cost, kind of that $600 to $700 for a report?
Yeah, most quantity surveyors are in that range. If they're not, then they're often trying to do reports without an inspection, which I'd never recommend unless it was a very specific circumstance. Say it was a brand new house where you had a given cost and you had plans and inclusions. But even in that example, often the plans and inclusions will say stainless steel appliance, or they'll say carpet to living areas. And you're like, well, does that include the hallway? And is stainless steel Technica or Gaggenau? And the difference between, say, a Technica and a Gaggenau oven is maybe about $20,000. So often it's worth spending that extra amount to get a proper schedule that's going to maximize it for you.
Yeah.
Here's
100%.
another, sorry, Jordan, but like, let's say you got one done 5 years ago, right? And then you've gone and done a bit of work since then. Should you get another?
I annoy people when I say it depends. Like, I love to say yes or no, but unfortunately, I'm going to have to talk about tax again. But I mean, you guys did invite me, so I don't know who you can blame. Why it depends is that, well, let's say, as an example, it's a split system, like I said before. If you've got the cost, then you can give that to your accountant and they can write it off. You can alternatively give that to us and we'll update your schedule free of charge. If you're adding, say, 5 items and they're all plant and equipment items, then the accountant can look it up. However, if you're spending, say, $80,000 to get a builder to do a new kitchen and bathroom, builders don't tend to say, congratulations, Joey, on your new kitchen and bathroom. By the way, your oven costs this, your heated towel rail costs this, your spa bath pump costs this. I don't know, you just struck me as a spa bath sort of guy, Joey. So that's where I would say you need to get a quantity surveyor to tease that apart, because if it's all lumped into one, it's going to be 2.5% deductions each year as a structural deduction. Whereas if it's carpet, it's going to be a 25% deduction. So, that's a 10 times increase if you can bring the plant items forward. So it's the same deduction over 40 years, but do you want to wait 40 years to get it back, or do you want to try and get that up front? And if you think about the time value of money, it's always much more beneficial to do it at the beginning.
Yeah, so you guys will update the schedule, as you said. Let's say I had to replace an air conditioning, for argument's sake, or something else, or a new oven. You'll update your client schedules.
Yeah. I mean, if you've done, say, 20 or 30 different items, we might sort of say, like, Joey,
we need to have another look. Yeah.
I love Shiraz, and it'll cost you one for me to do this. Or, if it's detailed, it might be, look, we've got to go back to site. There's some costs involved, but we see the benefit in it, and we don't recommend anything that isn't beneficial to the client. So if they come to us with a property where the deductions don't stack, we say, look, we're sorry, we'd rather help you with the next one.
And on the flip side of that, in terms of like not having a depreciation schedule, I mean, I'm a big culprit of this. On my first investment property, I didn't get one for the first 2 or 3 years. I didn't even realize what one was or why you needed one. And I was kind of in that mindset of like, oh, I've missed the opportunity now. I'm not going to be able to claim what I wanted to claim. Is that true? Like, are you too late if you miss out on the first 2 or 3 years, or how does that all work?
Yeah, it depends how long you miss out. So you used to be able to go and back claim 4 years. For the last decade or so, it's been 2 financial years. So when you go and do your tax return, you can actually pay your accountant to amend your 2 previous financial years. So that's an important thing to consider. And certainly there are people that miss out on deductions. They wait too long. We did a study on this. So we were the first firm to actually say the amount of time it takes people to order a schedule and to audit the missed deduction. So what we did is we looked at 1,000 residential property investment transactions, and we calculated the average missed deduction. So we found that 6.7% of our clients waited so long that they wouldn't be able to access some of their claim as a back claim. So what we're saying is that they waited more than those 2 years of back claim. And the average, I think, was 3.8 from memory. But what we did find out is that the average deductions that are missed by those 6.7% of investors was $20,537. So that's very significant. That could be $6,000, $7,000, $8,000 gone from your back pocket. The worst example of that was a lady bought a unit off the plan 16 years prior to contacting us. And it keeps me up nights thinking about the deductions that she lost. We still got her a great result in the back claim, right? The report paid for itself 1 million times over in the first year. But yeah, people miss out on deductions. And one thing if you'll indulge me, because this is a long answer, one thing I think is important in that, people might say, look, 6.7%, that's not a huge portion, but that's 6.7% of people that eventually figured out that they need us or someone like us. There's a lot of people that never figure it out, so those numbers are probably low. And even if you take that 6.7% and you put that across the entire investor population, we crunched the numbers, there's $2.88 billion worth of missed deductions sitting out there in the ether. So that's big biscuits.
Yeah, ouch. So for example, I wanted to engage your services, right? Like, what's the actual process? So you've mentioned that someone needs to go to site. As an investor, do I need to organize that? Do you liaise with my property manager? What's the actual process there?
Yeah, the first step is we get to know your property. So if you were to get in touch with us, we'll say, what did you purchase? When was it built? Do you know if it's had any improvements? Have you done anything to yourself? Have you lived in it? these all help us to get a very quick picture of whether it's worthwhile. So once we come to that conclusion, we'll say, yeah, look, we can definitely recommend a schedule. It's going to be beneficial for you. Then we look after the whole thing. So you can provide us with your property manager's details. They can provide us with the tenant's details, and we'll go and inspect the property. Sometimes we meet the property manager, but you certainly don't have to book that yourself. We send out a request for information, which is, your full legal name that you purchased it in, your settlement date, your purchase price. If you've made any additions, what are they? So there's some basic information that we need, but we turn that all around pretty quickly. And the end result is that 40-year report, which is the nice, neat package, which goes into tremendous detail because mostly it's accountants reading them. But there's a video that we send after our report that says how to read the bloody thing as well, right? So you can say, forget all the pages. If you want to know what the deductions are for your first year, this is the page to go to. And yeah, we pride ourselves on looking after as much as we can for the investor.
Is that actually what the video is called? How to read the bloody thing?
How to read the bloody thing? No, that's very Lara Bingle, isn't it? No, but I don't know. Maybe we'll split test it. We'll see what the data says. Check the open rate.
But just like as an investor, and lots of people just go, gee, tax, it's just such a mind-boggling topic, and I don't want to do X, Y, and Z. I don't really want to think about it too much. It's, from what you've said so far, it's pretty a hands-off type of thing for myself as the investor.
Yeah, and I get it. I mean, I pay my accountant to make things go away. Like, I don't want to know,
right?
Like, it's painful, it's terrible. Like, I have, to put it in a weird way, I have kind of dedicated / wasted my life knowing all there is to know about tax depreciation, right? Maybe I've wasted it, but like, that's a value to you, right? Because you don't have to waste yours diving into it. So that's where I think, we value our experts. So there's limited stuff that we need from you. We try to make it as less painful as possible, but really we look after the whole thing from start to finish, and we don't do it if there's no benefit to the client.
And you always show that, Mike, with all your conversations. Like I'm always fathomed by the numbers that you can rattle off by the top of your head and statistics. And I know you guys do a lot of data analysis and research over there, which, really you don't have to, but you provide it to the community anyway. I mean, we're talking off air, and you're providing suburb reports to your clients and stuff like that. So it's not just a wham bam, here's your depreciation schedule, thank you very much for your business. You generally got an interest in the industry. You run the podcast yourself, you got all these insights and you rattle the numbers off. So thank you for your input to the industry, mate. We really appreciate it.
Well, that's very kind of you to say. I mean, like, my business partner and I sort of talk about, we're not saving babies. I wish I was clever enough to do something like that, but we care about the journey of the investor, right? Most investors are struggling by virtue of 72% of them only get one. We want to change that stat. We want people that invest in property to be able to change their financial future. And I think just putting them in touch with good quality information and helping them and guiding them, tax depreciation is just one part of it for us, but that's of course our special subject.
So for the listeners who want to try and find out a little bit more about your services, and how does someone get in touch with you guys?
Look, I'm pretty easy to stalk on LinkedIn. I've got a weirdly unusual name. I wish it was more exotic, but so it's Mike Mortlock. Our website's mcg, like the cricket ground, qs.com.au. So mcgqs.com.au. And if you go to that /the property pals, I'll put some data and some show bag stuff in there. I'll put a reduced fee for your listeners and a free estimate for deductions. I'll roll out the red carpet. So go and do that. mcgqs.com.au /the property pals. How's that for FM?
Mate, you're a legend. That's
that
was off the whim. We didn't organise any of that, and that sort of shows
you
what type of
that one. That's
type of bloke Mike is, mate. So. Mate, it's always a pleasure to catch up. Let's not let it be 6 months again. We should definitely do this again at some point in time, and it's always a pleasure.
Just
quickly, Mike, do you have any idea what mcg.com.au is? Is that just the actual cricket ground?
Yeah, well, actually, funny story. It was owned by Macquarie Bank, And I thought, oh gosh, I'm never going to get that domain because they're just going to sort of hoard it forever. They weren't using it. And then someone came up to me the other day and he said, would you be interested in mcg.com.au? And I'm like, yeah, but Macquarie Bank own it. He's like, oh no, they let it go and I bought it. And he wants so much money for it that we'll probably never get it. So it's mcgqs.com.au.
Only an extra 2 letters, mate. I'm sure people will survive.
That's awesome, Mike. Yeah, look, as Jordan said, Mike, it's been absolutely wonderful chat and really appreciate your insights and obviously the offer that you've given to our listeners and can't thank you enough for your time.
Yeah, pleasure. Great fun. And anytime, guys, and love the work that you're doing and the stuff you're putting out there. So keep it up.
Thanks, mate. I'll talk to you soon.
Much.